Hi friends, we are starting a face-to-face offline batch in Bangalore with SS Academy. That is for CA Final Financial Reporting paper number 1. Yeah, we'll be taking exactly 2 months from 1st November to 31st December. We'll complete it. It is starting from 1st November 2022. Yes, and in Jayanagara branch of SS Academy, we have morning batch and evening batch will be at Seshadripuram SS Academy. Right, and if the student is missing because of any reasons, right, they are going to get a backup class. All right, we'll ensure that their things, they will study and complete, and from the face to face batch, the benefits out of it. We'll be completing the syllabus in time. You don't need to postpone and you don't need to compromise for your goals. See you in the class. Please share this information with your friends. That will help me and as well. Thank you. Yeah, hi friends. Let us look at Ind AS 103, that is business combination, and you have a chapter business combinations and corporate restructuring. Yeah, let's have a quick look at this. Okay, as you know, they will be asking 16 marks or like 8 marks minimum question from this standard. Yeah, we can't do the solving the questions, that is not part of quick revision, but yes, all important points of this business combination are going to be covered in this discussion. Yeah, what is a business combination? Business combination is acquisition of one or more business. Okay, even though it is a pure merger. Yeah, here actually there is no concept of merger. It is everything is acquisition, and we will be following purchase method. That is what acquisition method also people will say. Right, as per accounting standard 14, we have amalgamation in the nature of merger, but that amalgamation in the merger is not there here. Yeah, we have only one exception, that is CCBC, common control business combination. That we'll see little later. Right. Generally, other than the within the business within the group acquisition, it is only purchase method. Correct. Next, what is a business? Business is an integrated set of activities. It is integrated set of activities and assets which are capable of being conducted and managed for the purpose of dividend or for the purpose of profit or for the purpose of correct na? Some we wanted to get the returns basically. That returns will be given to the investors. Remember, that is integrated set of activities and assets. Activity should be there and asset should be there, and there should be a outcome also should be there. That means here there should be minimum three characteristics. One is input should be there, and there should be process, that is the activities must be going on, and there should be an output. Yeah, and directly let us go to the important point from the examination. Okay, who is an acquirer? Generally, the acquirer is the one who will be transferring the cash or other assets or debentures. Correct. Who will be having the control over? Correct. He will be having the majority stake, that is above 50% stake. Correct. But this situation is correct. Normally, yes, this is correct. But there is an exceptional situation which is a reverse acquisition. Yeah, reverse, in case of reverse acquisition, even though issuer may not be the, I may be issuing the shares, but I may not be the acquirer, I may be the acquiree. Okay, yeah. So that is an extreme circumstance. It is not regular circumstance, which we will see about this also little later. Yeah, here after deciding who is the acquirer, you are supposed to decide next to what is the acquisition date. Acquisition date is nothing but the date on which you got the control over, or the date on which, generally at the date on which where you have issued the legal consideration. But it is not necessary. It is not necessary that same date has to be taken. Sometimes it may happen before also. It may happen later also. Which day you can start? You can control the board of director, control the company. That is more important to you. Why the acquisition date is important? Because you are supposed to measure the fair market value of the assets received or consideration given. Everything, the fair market value as on the date of acquisition is important. That's why the date has that much importance. Right. Next, if you see what is the how do you calculate goodwill or capital reserve? Yeah, goodwill or capital reserve, fair market value of the purchase consideration, whatever the consideration you have given, right? Plus, if you had already acquired some stake before getting the control, right? The fair market value on the date of acquisition is supposed to be taken, right? Minus the value of the, plus value of NCI, non-controlling interest. Yeah, non-controlling interest, how do you measure? Again, there are accounting policies. Two accounting policies are there, whichever the company wanted to take it as in their accounting policy, no, that they can follow it. Minus fair market value of the net identifiable assets taken over by the company. Fair market value of net identifiable assets taken over by the company. We have a lot of discussion on this. The net amount is going to be the goodwill or capital reserve. If you are getting the goodwill, then there is no matter. Normally, right, goodwill is not going to be amortized over any number of years, my dear. Goodwill is going to be tested for impairment. Yeah, if you refer Ind AS 36, that is impairment of assets, there is an exception. Out of those three exceptions, one exception is goodwill arising from the business combination is not going to be, it is going to be tested for impairment every year, even though there is no indication for impairment. It is an exception to the normal rule of impairment. Yeah. Next, that when do you get this capital reserve? Capital reserve you can call gain from bargain purchase, you can call, right? Yes, normally this capital reserve or gain from bargain purchase is not possible, but we have got this gain from bargain purchase. The standard itself says test once again whether the fair market value of the consideration given is correct or fair market value of the assets taken over is correct. Just recheck once again because it is creating a doubt. No, sir. And if you can prove that there is any evidence that the gain is real, correct, okay, then you can route it. You have to route it through this gain should be routed through OCI, and it will be sitting in the reserves and surplus as a capital reserve. Sir, we are getting the capital reserve, okay, but there is no evidence that correct. Now, how this has come? There is no evidence. Under that circumstance, it will not be routed through OCI. It will directly be presented in the reserves and surplus. Okay, that helps you exactly. Now, there are some more important points, my dear. Okay, if you have got already some, before getting the control, you had already. Okay, if before getting the control, if you had already any stake, I said you have to measure fair market value of that stake on the date of acquisition, right? So in that measurement, if you get any gain or loss, that gain or loss is supposed to be transferred to P&L. Next, fair market value of consideration. Okay, sorry, once again. Suppose I had 30% stake, that means I had significant influence over the company, right? So I might have created what I must have created. I must have created revaluation reserve, or it may be FCTR because my associate has a foreign associate, or correct, or it might have done some revaluation reserve. Correct. Those OCI items should be accounted as if we sold the asset. That means if you had revaluation reserve, that should be transferred to retained earnings. If you had FCTR, that should be transferred to P&L as if my company had revalued it. What do I do if that fixed asset has been sold? As if I have a foreign subsidiary or foreign branch or foreign associate. If I had sold this, what will happen to FCTR? Same accounting is supposed to be done. Next, fair market value of the consideration. When I say if you had given money, cash or bank, then there is that whatever you are giving, that is itself is a fair market value. No, sir, I am issuing my company shares. Your company shares fair market value on the date of acquisition. You are supposed to take it. Suppose if you are giving any deferred consideration, yes, that also you are supposed to take the fair market value. Means you are supposed to discount the consideration, deferred consideration. Yeah, rate will be available in the question straight away. Next, so there is a contingent consideration. Yes, even the contingent consideration also you are supposed to measure it at fair market value. Okay, the fair market value measurement is based on the probability of occurrence. Yes, that only is supposed to be taken care. Okay, right. Next, suppose if you had paid any brokerage or something, if you had paid any brokerage or commission or something, okay, those kind of costs are not going to be part of purchase consideration given. That will be directly charged to profit and loss statement, my dear. The reason, it will not add any value to the assets or liabilities. Reason, we are already taking the fair market value of the net assets on the date of acquisition. Okay, right. Suppose we are issuing some debentures to the acquiring company. Yeah, we are issuing debenture. Okay, or some equity shares. The debenture issue expenses or equity issue expenses will be accounted as per Ind AS 109. Okay, that is not called as brokerage or other expenditures. That is not called as brokerage or other expenditure. Okay. Yeah, let us look at the non-controlling interest. Non-controlling interest, as I said, it is a choice. It is an accounting policy choice. The company has two ways of measurement. That is a policy choice. Again and again, I am telling you. Suppose if my company picks one choice, correct? Now that should be applied for all my subsidiaries. It is not like subsidiary wise you will be selecting. No, no, no. It is an accounting policy choice. Whatever you pick it, that should be applied to all your further subsidiaries in the future also. At one is you can measure the fair market value of the NCI, non-controlling interest, and that's all. Then what is the fair one share fair market value today? You take it, that number you will be applying it, right? And the other method is equal to proportionate share of net fair value of the identifiable assets. Proportionate share of net fair value of the identifiable assets you are supposed to take it. Okay, right. And so other components of NCI also is possible, my dear. That will be including the equity part of convertible debentures and etc. etc. That is not very important from the examination angle. And anyhow, from the gain from bargain purchase option, I have told you if you have any evidence, it will be routed through OCI. Otherwise, it will be directly sitting in the equity, I mean reserves on surplus as a capital reserve. We will be presenting it, right? Here, the next important, very important point is net identifiable assets. See the point, my dear, identifiable assets which you have assumed, which you have taken over, right? Identifiable in the sense what, which is separable, separately you will be, I mean, for the definition, you should refer actually Ind AS 38 intangible assets. Their intangible asset is an identifiable non-monetary asset without physical substance is the definition. Correct. So identifiable means which will be separately you will be able to sell it, separately I will be able to rent it or exchange it or use it, or it may, if it is arising from a contractual arrangement, then you don't need to have a separability even. Okay, done. That is a different thing, right? If you suppose if it is, if there is, I mean, acquiree has an intangible asset which is not recognized by the acquiree because it may be self-generated intangible asset, but we acquirer are supposed to take it because that is identifiable. Then I am supposed to take that also at fair market value. Here there is no restriction. At fair market value only you will be taking it, right? Suppose acquiree is doing some research and development, my dear. Acquiree is doing research and research process may it is in, correct, that's why research expenditure has been charged to P&L by the acquiree company. But I am paying some money for the research, then yes, whatever the amount you are paying, that itself is the fair value. Obviously there you cannot get a fair market value of the research in the market, which is not possible. Whatever we are paying, that itself is the fair value. You are supposed to consider, you are supposed to take that value also as it is. Subsequently, if you incur any research expenditure, then you are supposed to come back to Ind AS 38. That means subsequent research expenditure should be charged to P&L. Subsequent development expenditure should be capitalized as intangible asset under development, subject to six criteria. Right? And if you have the, I mean, you are sure that you will be completing, and so many other criteria is mentioned in Ind AS 38. Right. Next, there is some more concepts for what settlement of pre-existing relationship. Okay, if you are paying any consideration to settle the existing relationship, then your consideration amount is going to be reduced to that extent. I repeat once again, my dear, right? I am, maybe I have a, see, I am giving a consideration of 1,000 rupees. Okay, out of this 1,000 rupees, we are closing some liability part or something because we filed a case against them. Correct. Now, other party has to pay me. Right. No, I am supposed to pay them. Out of this 1,000 rupees, 200 rupees, I mean, say 50 rupees is with respect to settlement of the old relationship. Then what do we say? This 50 rupees should be taken it out. That should be accounted for separately. And we will say 950 is only the fair market value of the purchase consideration given. Next, any remuneration to the employees, for the future services, that is going to be an ESOP or SBP share based payment, which will be accounted afterwards. After the date of acquisition, we will be accounting because you are paying for the future services of the employee. Services will be done after the acquisition, and accounting also will be done after the acquisition. Okay, reimbursement of any acquisition related cost? No, it's all going to be charged to P&L, my dear. It's not going to be part and parcel. The reason, we are already taking the assets and liabilities at fair market value. That's it. Yeah, let me look at, I mean, let me take you through some important guidance which is given by the standard. One is contingent liability. Yeah, generally contingent liability as per Ind AS 36, it is supposed to be only disclosed, that but Ind AS 37 is not applicable when you are applying Ind AS 103. Okay, yeah, 103 will be overriding your 37. So then what are you supposed to do? The only reason here, even though it is not leading to probable future economic benefits outflow, right? The other two conditions, what are the other two conditions? Do you have a present application arising from the past event, and can you measure the fair market value of it reliably? Yes. Then contingent liability also should be taken it as a liability at fair market value on the date of acquisition. You are supposed to take it. Second point, income taxes. Income taxes, as you know, deferred tax asset cannot be created on the goodwill, okay, which is prohibited. Initial recognition of goodwill, you are not supposed to recognize it. But deferred tax asset or deferred tax liability with respect to all other items, with respect to all other assets and liabilities, because you are bringing it at fair market value, you are supposed to create it. What is the temporary difference here? Fair market value of the asset, what you are taking, minus book value of the acquiring company, that difference into tax rate you are supposed to apply, that you are supposed to take it into. Okay, next, employee benefit expenses, that is any provision for gratuity, superannuation, leave encashment, exactly as per Ind AS 19 you are supposed to follow. No new guidance has been provided by the standard. Okay, indemnification of assets. Indemnification in the sense, suppose if I incur any losses, then acquiring company is going to pay me. That means they have written and given it to you. Then it's obviously you have a right to receive, and it is virtually certain to receive. Then it is a kind of reimbursement of asset as per Ind AS 37. Yes, that should be recognized, my dear. Right. Remember the contingent liability. How do you measure it? In the same fashion, the indemnification of asset also supposed to be measured, but in the examination you have to be very careful, right? In language especially. Okay, see, if the acquiring company says we will be bearing up to 500 crore rupees of loss, okay, up to 500 crore rupees they have told, not minimum of 500 crore rupees. Suppose we are expecting 400 crore rupees of loss, then that 400 only will be receivable from the other party. That's why you have to be careful with the language what they use it. Otherwise, I mean, you may do an error. Okay, mistake is very much possible. Next, reacquired assets. Yes, reacquired asset. I mean, acquired only must have given an asset to the acquiring company. Okay, maybe franchisee right or any other telecom right or something like that. But subsequently, when you are acquiring it, you are supposed to take it at fair market value as on the date of acquisition. Okay, and that will be amortized. Over the considering, I mean, what is the remaining life of that asset and etc. You are supposed to consider. That is normal, nothing great as such. Assets held for sale. Okay, assets held for sale. Right. Remember here, what is that one sentence we said, my dear? All the net identifiable assets, everything will be measured at fair market value. But there is an exception to this rule, that is non-current assets held for sale. If it is a non-current asset which is held for sale, that will be recognized not at fair market value, my dear. Fair market value minus selling cost will be applying it. But this only selling cost will not be applied to any of other assets, my dear, only with respect to non-current assets held for sale. Got it? Next, SBP. Yeah, with respect to SBP, yes, the questions can be asked. Yeah, in case of SBP, share-based payment, yeah, that generally what happens, you may be replacing. I mean, acquirer will be giving a fresh share-based payment plan. That is part and parcel of the acquisition. It is part of the agreement basically. In this case, what are you supposed to do? The fair market value of the new plan, what you are giving it, the on the date of acquisition is supposed to be bifurcated into two. One is before, that is pre-combination services and post-combination service. Whatever is the pre-combination service, that should be considered as part of the fair market value. I mean, that is part of the consideration. And the post consideration will be charged to P&L, that is like employee benefit expense account debit to SBPR and all. That is after the date of acquisition when the people perform the services. Okay, so now what are you supposed to do? First thing, the fair market value of the new plan. The fair market value of the new plan on the date of acquisition is supposed to be bifurcated into two parts. Correct. So pre means how do you do it, sir? Means fair market value of the old plan, right? pre-combination service is equal to fair market value of the old plan into vesting period completed divided by old plan vesting period or the new plan vesting period. Okay, whichever is higher, you are supposed to take it. Yeah, division, what is that? Is I told you the greater of total vesting period of the old, total vesting period of the new. Whichever is higher, you are supposed to take it. Right? You got the pre-combination number. This pre-combination number, you are supposed to reduce it from the fair market value of the new plan. Fair market value of the new plan minus pre-combination number is equal to post-combination number. Post-combination number, I told you, for the remaining period of vesting period, that is supposed to be recognized as employee benefit expense account debit to SBPR or SBPL. It depends upon the equity settled share based payment or cash settled share based payment. Okay, right. If it is an intangible asset, that I already told you, if it is identifiable, then you are supposed to recognize it. Even if it is a research and development also, you are supposed to recognize it, because there is a fair market value. What is, I mean, agreed value is already been paid to the other party. Right. With respect to leases, okay, the acquiree has entered into already leases, correct? Then acquiree, what is acquiree? Acquiree may be a lessor to the lease agreement, or acquiree may be lessee to the lease agreement. If he is a lessee, then he has to recognize as usual ROUA account and lease obligation, that is LO. ROUA and LO supposed to be recognized, unless the two exceptions are given by the Ind AS 116. Which are the two exceptions, my dear? That is, if it is a short-term lease, that is the, I mean, lease period is less than or equal to 12 months, or the, I mean, less value items, then you can ignore it. Otherwise, you are supposed to recognize LO and ROUA. What is LO amount, sir? LO amount is nothing but from today onwards, whatever is the future obligation to pay. Whatever the future obligation from the date of acquisition, what are you are supposed to pay, that you bring it to present value, that is LO. LO is equal to ROUA. I mean, here there is no gain or loss, my dear. Directly ROUA account debit to LO you will be recognizing if you are a lessee to the agreement. Sir, no sir, I am a lessor, sir. If it is a lessor would have classified the lease into either finance lease or operating lease, my dear. Correct. If it is a finance lease, what will be there? What is the amount I am supposed to receive in the future? That will be recognized as an asset. That is a net investment in the lease for you. Exactly. Right. And if it is an operating lease, then obviously fair market value of the leased asset. Correct. Asset you would have asset only will be recognized by the lessor in case of operating lease. Fair market value of the leased asset will be recognized in our books of account. Yeah, that is about the initial recognition. All other specific guidance given by the standard. Let us look at the measurement period. This measurement period means the standard has given 12 months time from the date of acquisition till 12 months time, because the fair market value of consideration what you have given, you have to measure. Fair market value of the net assets taken over also you are supposed to measure. The measurement will take some amount of time. Correct. Within the 12 months period, if you get to know about any error, correct. Now you thought fair market value on the date of acquisition is equal to one number. Subsequently, you got to know, no, there is some small error has happened. Then that error, you don't need to transfer. Suppose, I mean, lease obligation has increased or lease obligation has been decreased. Then you are not that decrease in the asset value or liability value. You are not supposed to transfer it to P&L. That should be adjusted with the goodwill or capital reserve. But remember, my dear, this adjustment is not with respect to changes took place after the acquisition. No, no, no. It should be with respect to those situations and conditions which are already existing as on the date of acquisition only supposed to be considered. So after 12 months, if something increase decrease happens, that will automatically hit the P&L. That time there is nothing to do with goodwill or capital reserve. Okay. Next, subsequent measurement of accounting. Subsequent measurement means it's, I mean, next balance sheet date, what are we supposed to do? Here also some 4-5 items are there. Suppose it is a contingent consideration, sir. Initially, contingent consideration is measured at fair market value, my dear. Yes. Sir, subsequently what will happen? Subsequently, it depends upon how did you recognize it. Sir, I have recognized the contingent consideration as a liability, sir. Okay. If it is recognized as a liability, then subsequently the contingent consideration value goes up and down. That will be hitting the profit and loss statement. No, sir. Contingent consideration is recognized as an equity, sir. Then we will not be remeasuring it. We will not be remeasuring it later. If it is an equity, we will not remeasure it later. Same, whatever the measurement initially happened, that only will continue on the balance sheet date. Will not increase or we will not decrease it. Next, reacquired assets. Reacquired asset is also like an intangible asset, my dear, that will be amortized over the remaining life of the asset by the acquirer. How long you can use it, or you want to test for impairment and etc. That all will be charged to P&L as usual. There is no new point in it. Next, contingent liability. Yeah, contingent liability. Initially, contingent liability is measured at fair market value. Exactly. On the balance sheet date, what are you supposed to do? Yeah, on the balance, you would have done the contingent liability. I mean, you would have transferred it to profit and loss some number. That means initial recognition minus subsequently whatever you transferred it. Or if you have contingent liability, like there is more probability that you may need to lose it. Whichever is higher, that means the book value or the what is the liability amount, financial liability amount, correct? Now whichever is, I mean, provision amount or whatever you call, whichever is higher only supposed to be presented. Increase decrease will obviously be transferred to P&L, nowhere else it will be adjusted. Next, indemnification of asset. Here also, indemnification means other party has given a promise that they will reimburse you something, correct? Yeah, if they are, suppose, yes, we lost the case, and if you have collected already, then remove the indemnification asset from your books of account. Sir, I mean, I have a doubt that whether they will pay me or not. That means there is an impairment of the asset. Then you impair and reduce it and reduce the asset value, transfer it to profit and loss statement, right? And with respect to reverse acquisition, my dear, yeah, three things basically very important points. One is consideration. This consideration, you are supposed to calculate. You are an accounting acquirer, but you are not the legal acquirer, right? As if, but actually, illegal acquirer would have issued the shares, but you have to measure the fair market value of the shares as if accounting acquirer had given. If I had given if I had issued the shares to purchase the 60% of stake, how many shares I would have issued? That is tricky point, little tricky point, but you are supposed to do that. Okay, that is how you have to, as if the accounting acquirer had acquired, how much I would have given, that fair market value you are supposed to take it. Yeah, preparation of consolidated financial statements. Yes, assets and liabilities will be measured at fair market value, but it is a legal acquirer, correct? Na? Legal acquirer assets and liabilities will be measured, but accounting acquirer assets and liabilities will be measured at book value only. We will not change anything. Okay, right. Next, earnings per share also, my dear. Shares issued by the legal acquirer. Exit from the date of assumption. Okay, right. Shares issued by the legal acquirer, you should assume that our shares are already there from the date of beginning. Yeah, these things are a little tricky unless until you solve one sum. Otherwise, you will not be able to understand from my words so easily, which I am very sure. Right. Next, last topic almost, that is CCBC, Common Control Business Combination. Yeah, here who is acquiring? Who is acquiring means who was my, ultimate parent company, correct? Not earlier, one company is acquiring another company, right? But both these companies are already controlled by the parent company. If this control was there before also, this control is there after also. There may be slight change in the minority interest, that is non-controlling interest, my dear. That is nothing to do with here. Yeah, sir, how do you account it? How do you account it? That is merger method we will follow. That means all assets and liabilities are supposed to be taken at book value, my dear, not at fair market value. Yeah, and because of this, goodwill can never arise, but because of this, capital reserve can arise. Okay, goodwill will never arise, remember. Okay, right. And even though merger has, suppose this CCBC took place on 30th 6, but while preparing the financial statements, you should be assuming that this CCBC took place in the beginning of the previous year. In the beginning of the previous year only, that assumption, considering that you are supposed to make financial statements are supposed to be prepared, right? The other information like consideration can be, here there's no restriction that it has to be only equity shares. No, consideration can be equity, cash, or debentures, or any other consideration can be given. But one point, whatever the shares we are issuing as part of the CCBC, that should be recorded at face value, not fair value. It should be recorded the nominal value, that is face value, not at the fair value. Okay, right. And if there is any difference between the share capital of the transferor and the consideration given, that has to be adjusted with the capital reserve. That has to be adjusted with the capital reserve. These are all the important points from Ind AS 103. If you feel this video is helpful to you, please comment one and like it. At the same time, share it with your friend. Let this be useful to your friend as well. Thank you and all the very best.